The tech sector might see another 25% surge to close out the year and lead into 2021. This analyst is bullish on the tech sector right now. He discusses how there's still some upside potential for where the tech sector itself can see another 20 to 25% potential upside as 2020 closes out and into 2021. He goes over the stay-at-home economy, the shutdown of traditional offices and retailers, and overall the drive towards staying a socially distant, more digital world, and that will help share prices of these large tech giants go up even higher. So in this video today, we're going to take a look at the FAANG stocks, take a look at their current position, and determine if we like them right now. The overall market has been on a light pullback over the past few weeks. We're finally seeing some red in the market, and now may be the time to jump in and get into these mega cap tech companies before we see a potential another 25% surge in share price. So in this video today, we're going to go over all 5 of the FAANG stocks, take a look at their current position, some future analyst expectations for the company moving forward, and help determine if we like them not only in the short term, but in the long term as well. So thank you for tuning in, everyone. As you know, I am the Gen Z investor, and every single day we talk about the stock market. We go over different stocks you can buy, overall stock market performance, and of course, we talk about any market news and headlines. And in this video, we're going to focus on the FAANG stocks and determine if now is the best time to jump in and buy. So please hit that like button and subscribe, and we're going to jump right into it. So the definition of a stock market correction is when a specific stock or index sees a decline of 10% from its recent high. So we're going to take a look at the FAANG stocks, and a lot of these stocks are actually in this definition of correction territory. The first one on the FAANG list is, of course, Facebook. Their most recent high came at over $300 a share, and they are currently sitting down over 13% from that current high. So we've seen a pullback of over 13% from this company over the past few weeks, and at its lowest point as of late, they were down close to 16%. So Facebook, ticker symbol FB, is actually considered 12.4% undervalued at this current share price. Analysts have an expectation for the fair value of the shares at around $296 and being traded at just under $260. Now may be a nice time to jump in and buy. Analysts also have a lot of strong-term outlook for Facebook over the next 5 years, and it is expected that this company will grow at a rate of over 20% per year over the next 5 years, which is absolutely incredible. They also have a rock-solid financial statements. They have growing total revenue year over year at a very fast rate. Even in the past 12 months, we've seen an increase in revenue. This was during a period of time where Facebook's actually been under some scrutiny. People have actually been kind of pulling ads off of the Facebook platform, but that still doesn't matter. The overall revenue of the company continues to grow year over year and quarter over quarter. They also have a beautiful balance sheet. They have a strong current position with over $58 billion worth of short-term cash and investments. And overall, they have a nice growth in total assets over the long period of time and a very nice overall ratio from their balance sheet as well. One thing we're going to know with all of these FAANG stocks, they have some of the best financial statements in the market. They have strong balance sheets, great income statement growth, and all of these companies have posted beautiful numbers over the past 5 years. And like these investors who are really following the market are seeing, they're seeing these healthy balance sheets with high flying valuations. But like this analyst report sees, they can expect to continue to rise for another 20 to 25% by the end of 2020 and into 2021. The second FAANG stock we have to take a look at is the e-commerce giant, which is Amazon. They are on a pullback as well. Shares peaked at over $3,500 a share, but I've seen a pullback to now over 10% decline, so just slightly in that correction territory, down $360 per share from their peak. This is another massive company with a beautiful revenue statement. They are the largest e-commerce platform in the world. They're diversifying their income. They're expanding the business, of course, out of just the actual retailer platform that they use, Amazon.com. They're expanding. They're in so many different aspects of the platform, digital e-commerce world. So many different revenue streams, so many different businesses. They're doing a great job of acquiring smaller tech firms as well. And you can see here from their income statement, absolutely incredible numbers. 5 years ago, they brought in $100 billion of total revenue. Meanwhile, in the past 12 months, that has grown to over $321 billion. So they've more than tripled their revenue in a matter of 5 years, which is absolutely incredible, and a stellar upward trend. And this company is doing exactly what we want it to do. And analysts are very bullish and have a very strong projection for Amazon. And they actually believe over the next 5 years, the company is going to grow at an average rate of over 36% per year. That is absolutely astounding for this company that's already worth over $1.5 trillion. This growth rate is incredible, and analysts expect massive double-digit annual growth from Amazon over the long term as well. So now, Amazon being down 10%, is this the attractive price point to jump in and buy this e-commerce giant? Especially when Amazon Prime Day is occurring next week. They actually created their own holiday for their platform. It really kind of helps consumers jump in and motivates them to buy. And with the physical retail locations being shut down because of the pandemic, this holiday season, there's going to be a lot of gift shopping and holiday purchases made online. And Amazon, I believe, is going to be a major player in that market. They already dominate the e-commerce sector, and they've never even gone through a period of time like this where more than ever, people will be shopping online for their goods and gifts during the season. And during the holiday season, people are actually incentivized to spend more. They don't feel as bad spending a lot of money online and on purchases. So Amazon may post record-breaking results over the Q4 2020 and entering into 2021. So being on a dip of around 10% right now, just entering that correction territory, this may be an attractive price point to jump in and buy the e-commerce giant. The third FAANG stock, the other A, which is Apple, currently sitting at $114 a share. Of course, another company on a nice pullback, down over 14% from their most recent high. This is another beast. This is the largest company on the stock market right now with a valuation just shy of $2 trillion. An absolute giant. They do pay out a dividend yield right now, yielding 0.71%. Very low starting yield, but they average their dividend growth of over 10% per year. And you can see here 10.5% average annual growth over the past 5 years. And they have a very low 25% earnings payout ratio. So they have a lot of room to retain earnings back into the business, to help grow operations and expand, to make acquisitions, and to overall grow revenue and income over the long term. And they're only paying out 25% of their earnings in the form of a cash dividend, which leaves a lot of money left over for the business to increase that dividend payment each and every year. And that's what they've been doing with a very nice 10% average dividend growth rate. They have a stellar balance sheet as well, with over $93 billion in cash and short-term investments on the balance sheet. It gives them so much money to really expand and do anything they want to do. $93 billion allows them to achieve and go after any type of business there is on the market. They can really help them expand and innovate, and they have enough money on hand to do whatever they feel is right to help grow the business. Analysts are still expecting nice things from Apple. Although it is the largest company at around $2 trillion right now, they're still expecting around a 12.46% annual growth for this stock over the next 5 years, which will be nice numbers to see. Moving on to the N, which is Netflix. This FAANG stock is down as well, currently down 8%. So not down as bad as Amazon, Apple, or Facebook, but they're approaching that correction territory, down 8%. So of course, the video streaming platform, one of the most powerful and most popular platforms in the world, current market about $225 billion. This is another company that's been on fire. Their streaming service is beloved by a lot of individuals all across the world. They're doing a great job of actually creating their own shows for their platform, so they actually own the rights. Now with a lot of other companies coming out with streaming services, people are worried that Amazon's content on their show, on their platform, and their shows on the platform couldn't compete with the other old-fashioned traditional media who own some of the most popular shows in the world. But Amazon has been competing very well. They're making their own movies, their own TV shows, and they're doing a nice job of competing in the industry and putting out beautiful content that investors and consumers both alike. So they are expecting massive things from Netflix to continue to grow. So over the past 5 years, Netflix has been growing at a rate of over 76% per year, and analysts expect them to grow and continue to grow at a rate of over 35% per year. So there's some massive growth expectations for this company, and overall this company is expected to continue to post massive double-digit growth in not only users and revenue, but also earnings as well over the next 5 years. And the final FAANG stock, it is Google, ticker symbol GOOGL. From their most recent high, they are down 14.6%. So another FAANG stock in that correction territory, valued at around $1 trillion. This is another company that's seen a nice pullback away from their most recent high. Google's an interesting company. They essentially are a monopoly. They dominate their respective industry. And people like Jeff Bezos, Steve Jobs, all these, some of the most innovative market leaders in history, one thing that they've all agreed on is that Google is not a company that you try to beat. They are a mountain that you try to climb. They are a company where you just try to maintain and continue to grow with. Google is a monster. I believe this company for sure will not be going anywhere anytime soon. They're just too powerful. They're too nicely well diversified. They own assets in various different industries in the tech world. And I believe this is a brand in a company that will be here for a long period of time. And this stock right now might be a great price point to get in. 5% undervalued at their current price point on this current pullback. Overall, massive balance sheet, currently holding over $121 billion of cash and investments, which is absolutely incredible. Another company with so much cash available, they can really do anything they ever wanted, in of course, an effort to help grow the business. And analysts are expecting minimal growth from the company, which is kind of weird. They're only expecting around a 5% annual growth rate for Google. Very interesting from this tech giant, but we will see if they will outperform analyst expectations over the next few years. So that was a quick overview of all the FAANG stocks, where they're currently sitting at their current price point. If we're going to see a surge of over 20 to 25%, now might be a time to jump in and buy because of this great deals we are seeing on the market. Of course, with a second wave of the pandemic possibly occurring, we may see another stock market decline, but no one knows for sure. And these tech giants we already saw are in correction territory. A couple of them are down over 10% right now, and this may be a great opportunity to lock in some low prices, average down into your portfolio, and lock in some of these tech giants, which I believe will be around for a long period of time. So thank you for watching, everyone. I am the Gen Z Investor, and I will see you in tomorrow's video.